Want to invest your money but feel overwhelmed? You're not alone. The stock market can seem like a complicated maze. That's where ETFs come in. Think of them as your ticket to easy and effective investing. They're like baskets of stocks, bonds, or other assets, all bundled together. ETFs are gaining popularity, and for good reason. They offer a simpler way to diversify your investments without the hassle of picking individual stocks. Whether you're just starting or you're a seasoned investor, ETFs can be a valuable addition to your portfolio. In this guide, we'll break down everything you need to know about ETFs in simple terms. From what they are to how they work, and the benefits they offer, you'll become an ETF pro in no time. Let's get started. Unpacking the basics. Let's demystify ETFs. ETFs, or exchange-traded funds, have become increasingly popular among investors. But what exactly are they, and why are they so appealing? ETF stands for Exchange-Traded Fund. This means that an ETF is a type of investment fund and exchange-traded product, meaning it is traded on stock exchanges much like stocks. Simply put, it's like a mutual fund that trades on a stock exchange. Unlike mutual funds, which are priced once at the end of the trading day, ETFs are priced and can be bought and sold throughout the trading day. Imagine a basket filled with different stocks, bonds, or other assets. This basket represents a collection of various investments bundled together. That's what an ETF is. It's a single investment that gives you access to a wide range of assets, all in one package. When you buy an ETF share, you're buying a piece of that entire basket. This means you own a small fraction of all the assets within the ETF. This means you get instant diversification, spreading your risk across multiple holdings. Diversification is a key principle in investing because it helps to mitigate risk. Instead of putting all your eggs in one basket by investing in a single stock, you're investing in a whole bunch of them with just one ETF. This way, if one stock performs poorly, the impact on your overall investment is minimized. ETFs track specific indexes, sectors, or commodities. This tracking allows investors to gain exposure to a particular market segment without having to buy all the individual securities within that segment. For example, an ETF might track the S&P 500 index, giving you exposure to the performance of 500 large companies in the US. This means that by purchasing a single ETF, you can invest in a broad swath of the market. This makes ETFs a flexible and accessible way to invest in various aspects of the market. They offer the benefits of diversification, liquidity, and lower costs compared to mutual funds. Additionally, ETFs can be a great tool for both novice and experienced investors looking to build a balanced portfolio. Over the years, the ETF market has grown significantly, with thousands of ETFs available covering a wide range of investment strategies and asset classes. This growth reflects the increasing demand for these versatile investment vehicles. Whether you're looking to invest in domestic or international markets, specific sectors like technology or healthcare, or even commodities like gold and oil, there's likely an ETF that fits your investment goals. One of the advantages of ETFs is their transparency. Most ETFs disclose their holdings on a daily basis, allowing investors to see exactly what they own. This transparency helps investors make informed decisions and understand the risks associated with their investments. In summary, ETFs are a powerful tool for investors seeking diversification, flexibility, and cost efficiency. They provide an easy way to gain exposure to a wide range of assets and market segments, making them an essential component of a well-rounded investment strategy. So the next time you think about investing, consider the benefits of ETFs and how they can help you achieve your financial goals. Happy investing! You might be wondering how these ETF baskets are created and traded. ETFs, or exchange-traded funds, have become incredibly popular investment vehicles, but their inner workings can seem a bit mysterious at first glance. Well, it's all about a process called creation and redemption. This process is fundamental to how ETFs function and maintain their value. Large financial institutions, often called authorized participants, work with ETF providers to create and manage the ETF shares. These authorized participants are typically big players in the financial world, such as investment banks or other large financial entities. Here's how it works. The authorized participant buys a large block of the underlying assets that the ETF will track. These assets can be anything from stocks, bonds, commodities, or a mix of various securities, depending on the ETF's focus. They then deliver these assets to the ETF provider in exchange for a large block of ETF shares. This exchange is crucial because it allows the ETF to hold a diversified portfolio of assets without having to buy and sell individual securities constantly. These ETF shares are then listed and traded on stock exchanges just like individual stocks. This listing makes ETFs highly accessible to everyday investors who can buy and sell them throughout the trading day. When you buy or sell ETF shares, you're trading with other investors in the market, not directly with the ETF provider. This secondary market trading is what gives ETFs their liquidity and flexibility. This process ensures that ETF prices generally stay close to the value of their underlying assets, known as the net asset value, NAV. The NAV is calculated at the end of each trading day and represents the total value of the ETF's assets minus any liabilities, divided by the number of shares outstanding. If the price of an ETF deviates significantly from its NAV, authorized participants can step in to arbitrage the difference. They do this by buying the ETF shares if they are undervalued or selling them if they are overvalued, and then exchanging them for the underlying assets or vice versa. This arbitrage mechanism helps keep the ETF's market price in line with its NAV. For investors, this means that ETFs offer a convenient way to gain exposure to a broad range of assets with the added benefit of liquidity and real-time pricing. Whether you're looking to invest in a specific sector, track a market index, or diversify your portfolio, ETFs provide a versatile and efficient option. There are many types of ETFs available, each designed to meet different investment goals. Some ETFs track major stock indices like the S&P 500, while others focus on specific sectors such as technology, healthcare, or energy. There are also bond ETFs, commodity ETFs, and even ETFs that follow alternative investment strategies. Understanding how ETFs work can help you make more informed investment decisions. By knowing the creation and redemption process, the role of authorized participants, and the importance of NAV, you can better appreciate the mechanics behind these popular investment tools. So, the next time you consider adding an ETF to your portfolio, you'll have a clearer picture of how these innovative financial instruments operate and why they might be a good fit for your investment strategy. The world of ETFs is incredibly diverse. With a plethora of options available, investors can find an ETF that aligns perfectly with their financial goals and interests. Whether you're a seasoned investor or just starting out, the variety of ETFs can cater to your specific needs and strategies. There's an ETF for almost every investment strategy and interest. From broad market indexes to niche sectors, the range of choices is vast. This flexibility allows investors to tailor their portfolios to match their risk tolerance, investment horizon, and market outlook. This variety is one of the reasons ETFs are so popular. They offer a convenient way to gain exposure to different asset classes, sectors, and regions without the need to buy individual stocks or bonds. This can simplify the investment process and make it more accessible to a wider audience. Let's look at some common types of ETFs. Each type serves a unique purpose and can be used to achieve different investment objectives. Understanding these categories can help you make more informed decisions about which ETFs to include in your portfolio. These ETFs track specific market indexes like the S&P 500, which represents the performance of 500 of the largest companies listed on stock exchanges in the United States. Index ETFs are a popular choice for investors looking to replicate the performance of a particular market segment. The Dow Jones Industrial Average or the NASDAQ 100. These indexes cover different segments of the market, providing investors with various options to diversify their investments. For instance, the Dow Jones focuses on 30 large, publicly owned companies, while the NASDAQ 100 includes 100 of the largest non-financial companies listed on the NASDAQ stock market. For example, the SPDR S&P 500 ETF, SPY, is a popular index ETF that tracks the S&P 500. It allows investors to gain exposure to the overall performance of the U.S. stock market with a single investment. Want to invest in a specific industry? Sector ETFs focus on sectors like technology, healthcare, or energy. These ETFs allow investors to target specific areas of the economy that they believe will outperform the broader market. Sector ETFs focus on sectors like technology, which includes companies involved in the development and production of technology products and services. This can be an attractive option for investors who are bullish on the tech industry's growth prospects. Healthcare, which encompasses companies that provide medical services, manufacture medical equipment, or develop pharmaceuticals. Investing in healthcare ETFs can provide exposure to a sector that is often considered defensive and less sensitive to economic cycles. The Energy Select Sector Spider Fund, XLE, is an example of a sector ETF. It focuses on the energy sector, including companies involved in the production and distribution of oil, gas, and renewable energy sources. These ETFs invest in a variety of bonds, offering diversification within the fixed income market. Bond ETFs can include government bonds, corporate bonds, municipal bonds, and more. They provide a way to gain exposure to the bond market without having to purchase individual bonds, offering diversification within the fixed income market. This can help reduce risk and provide a steady income stream, making bond ETFs a popular choice for conservative investors or those looking to balance their portfolios. The iShares Core U.S. Aggregate Bond ETF, AGG, is a popular bond ETF. It aims to track the performance of the U.S. investment-grade bond market, providing broad exposure to a wide range of bonds. Interested in gold, oil, or other commodities? Commodity ETFs track the prices of these raw materials. They offer a way to invest in physical commodities without having to buy and store the actual assets. Oil, or other commodities? These ETFs can be a good hedge against inflation and provide diversification benefits, as commodity prices often move independently of stock and bond markets. Commodity ETFs track the prices of these raw materials. They can include precious metals like gold and silver, energy resources like oil and natural gas, and agricultural products like wheat and corn. The Spider Gold Shares, GLD, is an example of a gold ETF. It aims to reflect the performance of the price of gold bullion, providing investors with a cost-effective and convenient way to invest in gold. These are just a few examples of the many types of ETFs available. The ETF market continues to grow, with new and innovative products being introduced regularly. This expansion offers investors even more opportunities to diversify and tailor their portfolios. As you explore the ETF universe, you'll discover even more specialized options, such as international ETFs, which provide exposure to markets outside of the United States. These can be a great way to diversify geographically and take advantage of growth opportunities in other regions. You'll discover even more specialized options such as international ETFs, which provide exposure to markets outside of the United States. These can be a great way to diversify geographically and take advantage of growth opportunities in other regions. ESG, Environmental, Social, and Governance. ETFs focus on companies that meet certain environmental, social, and governance criteria. These ETFs are becoming increasingly popular as more investors seek to align their investments with their values and support sustainable business practices, and thematic ETFs that focus on emerging trends. These ETFs can target specific themes or trends, such as technological innovation, clean energy, or demographic shifts. They offer a way to invest in the future and capitalize on long-term growth opportunities. Thematic ETFs can be particularly appealing to investors who have a strong conviction about a particular trend or industry. By investing in these ETFs, you can gain exposure to a basket of companies that are positioned to benefit from these trends. In conclusion, the world of ETFs offers a wealth of options for investors. Whether you're looking to track a broad market index, focus on a specific sector, invest in bonds, or gain exposure to commodities, there's likely an ETF that fits your needs. By understanding the different types of ETFs and how they can be used, you can build a diversified and resilient investment portfolio. So, take the time to explore the various ETF options available and consider how they can help you achieve your financial goals. With the right mix of ETFs, you can create a well-rounded portfolio that aligns with your investment strategy and risk tolerance. Remember, investing in ETFs is not just about choosing the right products, but also about understanding your own financial objectives and how these investments fit into your overall plan. Happy investing. Happy.